Dear investors, welcome to the July and August 2025 monthly roundup video. In this month, the Nifty 100 index is down 1.5% and the Nifty Small Cap 250 index is down 3.7%. Tariff negotiations fell apart and Trump slapped 50% tariffs on select Indian exports to the US, predominantly textiles, leather, shrimp, exempting pharmaceuticals. This could impact GDP growth for the year FY 2026 by 0.6 to 0.9%. Mr. Modi is already in negotiation with other nations to improve bilateral trade deals for the ailing sectors. And BRICS is getting into action once again to negate the effect of US tariff impacts on the global economy. GST rates are also going to be revised downwards on the September 3rd meeting coming up to aid the economic recovery. In the coming months and years, I hope the Make in India approach would get a big boost. The problem is all these steps should have been taken proactively rather than as a reaction to the fallout of US trade deals because the policy roadmap preparation and their effects on the economy take time to show results. Meanwhile, the HSBC manufacturing PMI came in at 59.8 and the services PMI rose to 65.6, signaling significant growth in business activity and business sentiment. The inflation print for July 2025 also came in at a very low 1.55%. The private capex is still very sluggish in India, although the government capex is at 33% of the total planned capex for the year till now. This, coupled with good demand in goods and services and lower than expected inflation, has boosted the April to June quarter GDP growth to 7.8%, defying expectations. But the growth going forward is the one to watch out for, and that will set the course for the share market returns in the next 3 to 6 months. The bond market in India is behaving very weirdly recently, with the bond yields rising from 6.37% to 6.61% within a span of 1 month for the 10-year government bonds. Sometimes bond markets are much more aware of the economy and the general direction of markets than the share markets itself. So let's see how this pans out. With a lot of pressure from the Trump administration, the Fed chairman Jeremy Powell recently hinted at a rate cut in the US, most probably in the next 3 months. This move, although it signaled that the US economic growth is slowing down and it could have cascading effects on the growth in other economies, but would definitely be helpful for the Indian share market because the foreign exchange flows into India would increase going forward. Among all these uncertainties and Trump declaring India as a dead economy in the context of tariffs, S&P went ahead and upgraded the long-term rating on sovereign bonds in India from BBB minus rating to BBB with a stable outlook. This is the first ratings upgrade in India since 2007 and definitely a great news as government would be able to borrow external funds at a lower cost now. Hopefully, the Babus and politicians take clear steps to steer the Indian economy from slow growth to a high growth trajectory and improve the effectiveness of Indian businesses by reducing red tape. As far as the markets are concerned, they could go anywhere from here. But as they say, time in the market is much more important than timing the market or staying on the sidelines. In April, I had gone to purchase some furniture, and the shop owner started asking me what I did. Knowing that I run a mutual fund advisory business, somehow he felt very confident and shared something with me that blew my mind. मार्केट तो बहुत डाउन चला गया है, वर्ल्ड वॉर 3 होने वाला है ना, आपको क्या लगता है? No offense to such mind numbing ideas, but I am pretty sure he may not have invested a single penny in the Indian share market and would never ever benefit from the fastest growth engine out there in the world. Hopefully, you are not one of such persons trying to be a market pundit rather than an investor. Please consult your financial advisor and instead of putting huge sums of your savings in plot, flat, or gold, become an informed investor in mutual funds. The long term rewards could be immense, and if you follow a valuation based investing approach, then the returns could be even better. Hope this video has been useful. Thank you. Happy investing.